feedback to this point? Are you enjoying the delivery of the message? Anything you want us to change for the afternoon to help you to understand better what we're going through? Are we on the right track, or is there any feedback that you want us to modify for the afternoon part? No response. I think we're on track. So I'm going to turn it back over to Joe. And then, again, keep in mind, if you have any questions and you don't want to raise your hand, just write them on the card and get them to us. And keep in mind, I come from Rhode Island. It's C-A-R-D when I say card. It's just in case my accent. Sometimes I said it, and someone said, you want us to get a fish? So I said, no, it's C-A-R-D. So just write your question on there. Pass it up.
All right. So just a matter of clarification from this morning. I mentioned utility funds are all to be considered as major funds, and that is not a completely accurate statement. The utility funds, they would like them displayed separately, but then apply the criteria, the 25% criteria, to see if they should be major funds or not. So that is not an edict that has come from the state board. So I want to make sure that we clarify that and get that out on the table. So this section, from now until the break, we're going to talk about what it takes to actually prepare a set of financial statements and actually what they look like. And so I'm going to go a little bit out of order here. I was going to present the statements at the end, but I think it'd be a good idea to, let's take a look at a set of GAAP financial statements and see what they look like and kind of walk through them before we get into all of the meat and potatoes here of the next section. So, one of your own, Allen County has prepared a set of GAAP financial statements, and we've looked at these, and they're in very good shape. They've met all of the criteria and met all of the disclosures, and so I thought this would be certainly a good model to use. But I thought it'd be a good idea just to kind of walk through these and talk about the various areas and what they look like. So just moving forward, we have of course the cover page, then the table of contents, and you can see that this is pretty extensive. There's a schedule of officers and officials, the auditor's report, management's discussion and analysis, and this format is pretty much dictated, so you really can't deviate from this format. Following MDNA is the basic financial statements. We've talked a lot about basic financial statements, but there's actually two financial statements, the government-wide. Oh, very good, thank you. Make it a little bit bigger. The government-wide financial statements, which includes your statement of net position and statement of activities. Then the fund financial statements, which follow. We talked about the individual funds. So we have the governmental funds, statement of revenues, expenses, and changes in fund balance of the governmental funds, and then the reconciliation of the statement of revenues, expenses, and changes in fund balance to the statement of activities. Page 24, the statement of net position of the proprietary funds. So this is, again, on a full accrual basis, your proprietary funds, and then an income statement for the proprietary funds, which is the statement of revenues. Oh, good, thanks. Statement of revenues, expenses, and changes in fund net position for the proprietary funds. Proprietary funds also need a statement of cash flows. We talked about that. Then the fiduciary fund net position, and then a new statement of changes in fiduciary net position. One thing I'll point out here, if you look at the next line, the notes to the financial statements, start on page 29, they go to 76. The notes are extensive. A lot of information contained in those notes to the financial statements. The next section, required supplementary information. Again, information that's required by the Governmental Accounting Standards Board. Various items listed there. There's a employer contributions to the pension funds. Oh, okay, let me add the mic here.
Careful what you wish for.
Okay, is that better?
Yep.
No clip for the box though. Okay. Requires supplementary information, and then after that is supplementary information. So let's go to the MDNA. So the MDNA is something that I think will be new to a lot of you, and it's the thing about the MDNA is there's a prescribed format that the GASB requires for the MDNA. And it's important to make sure you stick to that prescribed format, because anything in addition to that really should be put in a different section of the report, or should be put in a transmittal letter. But you'll want to stick to the basic requirements of the GASB. So it starts out with financial highlights. We talk about, a couple of things that happened in the government over the year. Then an overview of the financial statements, talking about the government-wide financial statements and components of that. Here they have some component units. Let's scroll back for a second. Talk about component units included in the financial statements. Okay, fund financial statements. They explain what those are and what the major funds are. Then the proprietary fund financial statements. So it's just kind of an overview so far of what makes up the report and how it's used. Keep going. Then we get into some financial analysis where we're, now this is a one-year financial statement, but we have comparative numbers in the MDNA where we're talking about the changes that have occurred between 2016 and 2017. And this is broken down into major asset categories, and this is at the entity-wide level. So the first schedule we have here is the government-wide financial analysis, which talks about the governmental activities and the business-type activities. And then we have some narrative about what happened during the year, and what happened that caused changes, major changes in the net position of the entity.
Has there been any conversation about how they're going to get that prior year information, the MDNA, or is there going to be an excused omission in the first year?
Right. So do you want to tell them about the excused omission?
She'll need to make sure it's louder whenever that discussion.
Oh, okay. Yeah, Linda made a comment that since we're implementing this for the first time, and we're producing financial information for the fiscal year for the first time, how do you get the prior year information? What are you going to have to go back and restate the prior year to come up with that information? I think that's essentially what the question was.
That was the question, and I was just wondering if the State Board of Accounts have considered whether they will be allowed to just have 1 year for the implementation year. They'll still get a tweak to their opinion. It'll mention that the MDNA is not complete in accordance with the GASB requirements, but they could still get a clean opinion on their basic financial statement.
We would leave it to the unit of government itself to decide on whether they want to do it and explain to them what the modification would look like, in the opinion. they chose to only do it 1 year.
Okay.
Yeah, so, again, the requirement is the current year and prior year, but it
It
typically,
won't modify the anything else.
yeah, typically, when you have a major change like we're talking about, and it's the first year of a new standard or the first year of GAAP financial reporting, you don't have all the prior year information, so typically you make a comment that that's not available, and then there's a comment in the opinion that that information is just, it wasn't available. But here, we're showing the governmental activities, changes in net position. We have our program revenues up at the top, followed by general revenue, and then our expenses. Again, we're still within MDNA. We haven't even gotten to the financial statements yet. Here's some graphs with some important information. Very nicely done, showing revenues by source and expenses by function. Good information for the readers of the financial statements. Then we get into the business type activities, again with another pie chart. Now we're getting into the individual funds, talking about the funds that had major changes for the year. So then we talk about the budget, budgetary highlights. Let's skip ahead to the government-wide financial statements. So there's more and more information in the MDNA, but I wanted to show you what the actual statements look like. So here's the real live statement. It's statement of net position. This is at the entity-wide financial statement. So you can see the columns there. We have our governmental activities, we have our business type activities, and the total column is required, and then the component units. I don't know how many component units they have, but you can show the detail of component units elsewhere in the report. And then the assets are listed in order of liquidity, with your cash and investments being at the top, receivables, inventories. Oh, they even have assets held for sale, assets held for resale. So they must have acquired some property or something that they are planning to turn over. We have some restricted assets. Then scrolling down, capital assets. Here's something that's unique to government. This caption, deferred outflows of resources. And so they have unamortized loss on refunding. So they've refunded some debt, and there was a loss that they're amortizing, and this is the remaining unamortized balance. And then there's pension-related deferred outflows, and Bill is going to talk about the pensions a little bit later and how they impact our financial reporting. On the liability side, again, liabilities listed in order of your current liabilities first. Then we have, just scrolling down, deferred inflows of resources. So again, unamortized gain on refunding and more pension-related deferred inflows. And then finally, our net position. And net position we're going to talk about in a little bit in a great amount of detail because there's some calculations that need to go into how net position is set up and how it's laid out. So then the statements of activities, and again, the way this is laid out, we start out with our expenses or our program expenses first. The idea being the purpose of government is to provide service. So we're laying out our cost of service first, and then we're going to talk about how we pay for that cost of service, as opposed to a private sector business where sales or revenues are the number one thing that go on the top of their income statement. But we have both the primary government and the component unit listed across the top. We start out with our expenses, and then to the extent we have any program revenues, so revenues related specifically to those expenses. We may have charges for services, or we may have grants that are specific to the functions that are listed to the left. So then we come to a net governmental activity total. And then we have our general revenues, which follow. And general revenues can be applied to any of the functions. Property taxes are listed there, the largest item. It looks like there's some, economic development, distributions, I'm not sure what that is. But they have some excise taxes, food and beverage tax, capital contributions, and then there's some transfers that have occurred. And you'll see the transfers are shown in a negative amount. Those are transfers out of the government. And then, scrolling down, we have our change in net position, and then net position beginning and ending. And the ending net position listed here, of course, has to reconcile to the net position on the statement of net position. I'm not going to go through the details of all of the other statements, but the governmental funds balance sheet is next. After the governmental balance sheet, we have the reconciliation. And this is an important schedule because it reconciles the fund balances on the governmental statements to the statement of net position, the net position of the governmental activities. So again, accounting for stuff like long-term liabilities, pension, and fixed assets, all things that aren't reported in the fund statement are reconciling items here. So scrolling forward, statement of revenues and expenditures for the governmental funds. Oh, let's go back up. This was the point that was made. Back one statement. Go to your total assets. So a comment was made earlier about the general fund is always a major fund. The rainy day fund's a major fund. Local income tax is a major fund. And then we have all other government funds combined. And you can see the total there is 78 million, which is greater than any of all of the other columns put together. So this can happen when you're identifying your major funds. And one of the things that we would like to see, this is all perfectly correct, but we'd like to see if there's other funds in that other column that are very closely related. We'd like to see, perhaps combining those or pulling those together into a major fund so that, perhaps we have another major fund and less activity in the other column. Yes?
Is this a good time to mention the comment about the utility fund as a major fund?
Yeah, I talked about that earlier, right. The utility would typically be in the enterprise fund. And we got clarification from the state board that they'd like to see the utility funds presented separately, which I interpreted to mean as major funds, but they clarified that it doesn't have to be a major fund if it doesn't meet the criteria, but they still want to see it separately presented, perhaps in a combining schedule in the back of the report. So we still apply the 5 and 10% test to see if it applies. But yeah, here, so if we scroll down, to the statement of revenues and expenditures, here we have a little bit different picture because the general fund has the bulk of the revenues in this case. And all other governmental activities are 62 million, the general fund 98 million. So here the relationship is a little bit different. And same thing on the expenditure side.
And we'll make sure a copy of these statements are distributed to all the participants, so you have that to look at.
Yeah, and actually this came right off of the website. So this is available on the Allen County website. And then here's our reconciliation of the statement of revenues and expenditures and changes the fund statement to the entity-wide. Go ahead, scroll forward. I just want to flip through the notes quickly. Oh, well, we have our proprietary funds, statement of net position. But if you can skip to the notes. Again, the notes are extensive, but these are laid out very well. They start out with the reporting entity, but just if you want to scroll through this real quick, talk about the basis of accounting, restricted assets, interfund transactions, prepaid. Basically, anything on the balance sheet needs to have some type of explanation, and there are some required footnote disclosures. There's a checklist that's available that we can point you to on what goes into the footnotes. Linda's going to talk a little bit about it in a couple of minutes. After the footnotes, is the required supplementary information. Here we go, okay. So, here we're talking about the pension liability and required disclosures. Bill's going to cover that. More pensions. And then if we skip to the next section, here's where we find our combining statements. So, here's the remaining fund statements of the non-major governmental funds, all laid out separately and combined, and then these totals would roll up to the front financial statements. So, again, nice job. We can get back to the presentation now. Congratulations to Allen County. They should be teaching the class.
That was my question. Did they do that in-house or was that a consultant?
I don't know. I just pulled that off the website.
They do it in-house.
I'm impressed.
It's pretty good. Yeah, they did a good job. So that's a good sample to look at. So I covered all of this. The introductory section. We talked about the basic financial statements, MDNA. This on slide 89. This is the prescribed format of the MDNA. So it's important, I think, to flip to that. Don't add anything more or anything less. Stick to the required format. One of the things about the MDNA, it's supposed to be an analysis of what occurred. So they want you to talk about changes for the year. They want to talk about what has occurred. That one of the things that they particularly don't want in the MDNA is talking about the future. How things are going to change in the future and how much better it's going to be. You can have that type of information, but that should really be in an introductory letter that comes before the financial statements. So a lot A lot of statements you'll see are set up that way.
But just a comment, there is a lot of benefit, obviously, from the management discussion analysis. You think about going to your boards and having them look through a 150-page document. This is a nice synopsis of your net statements of net position, governmental activities, fund financial statements, and can pull it all together within 10 or 15 pages, along with analysis that you have of what were those fluctuations. So it is helpful at that level to pull it all together without getting into the weeds of all the detail in the back, and lost in the weeds.
Yeah, a lot of boards will just look at the MDNA and the analyses that you've prepared without even getting into the detail of the financial statements. So a lot of good information. Just one thing I want to point out to make sure we're all on the same page. In the commercial world, we have what's called a balance sheet, and typically your total assets equal your total liabilities plus owner's equity. But really in the public sector, we like to see this net position format where we have our assets and deferred outflows minus liabilities and deferred inflows, and we come down to a total being net position. And that's exactly how the Allen financial statements are laid out. Capital assets. Just assets and liabilities in general. Again, in order of liquidity, and it's recommended to have a classified presentation with your current assets separated from your non-current assets and liabilities. Another thing that's really important is that depreciating and non-depreciating assets have to be separated. So stuff like land and construction in progress, which are not depreciated, have to be segregated on the face of the financial statements from other things that are depreciable, like machinery and equipment, buildings, improvements, that type of thing. Some organizations choose to list out each individual asset category on the face of the statements, as well as accumulated depreciation. That's optional to have on the face, or you could put that back in the footnotes. But this is mandatory for the face of the financial statements. Liabilities. Again, we want liabilities presented in order of liquidity. We just have a couple examples here, and then if we have something that's due beyond 1 year, we'll want to break out the portion that's due within 1 year versus what is beyond a year. Inter-entity receivables and payables. So between governmental activities and business activities, to the extent we have internal balances, those need to offset one another, and the total net to zero. Discretely presented component units. Linda talked extensively about what they are, but as far as how they're presented, you have some options. You could have a single column for all the component units, or you could have a separate column for each unit. I think more popular what we see is a single column, and then the detail presented in the notes to the financial statements. And then remember, that's only for your discretely presented, because your blended component units are already considered as one of the funds of the government. Net position. Net position is equivalent to your net equity, and there's 3 categories that must be presented: net investment, capital assets, restricted, and unrestricted. And so we have some extensive formulas on how to calculate net investment in capital assets and restricted net position. I'm not going to go through all the details of this, but essentially they're looking at how much of your equity is invested in capital assets. So you start with the capital assets balance, both tangible and intangible, deduct your accumulated depreciation, you add and deduct a couple of other things related to the capital, the acquisition of those capital assets, and then you come down to, this is the amount of net position relative invested in capital assets. Restricted net position, same type of thing. There's a formula for that. Restricted resources, less restricted liabilities and deferred inflows is restricted net position. So a restricted liability is a liability that's paid from restricted resources. And restricted means something that's externally enforceable. So constitutional provisions, bond covenants, grants, enabling legislation, stuff like that.
Yeah, so if we have a special revenue fund with a restricted balance and we have some unavailable revenues that haven't been recognized on a modified accrual, when you come to the front, that restriction is going to be adjusted for the fact that we're recognizing that revenue on the full accrual, right?
Yep. So some of the details of the restrictions are up here. The amount of restricted fund balance always has to be a positive number. You can't restrict something that you don't have, so that's necessary. And also the restrictions need to be on the face of the statements. And then the final category of fund balance of net position is unrestricted net position. This is the residual category of what's left over, and this can be negative. So it'd be possible to have, you could have negative, positive or negative net investment capital assets, positive restricted, and then whatever is left over is your unrestricted. Okay. Polling questions. We already know the answer to this. The basic financial statements include all of the following: true or false? MDNA, statement of net position, statement of activities, the fund financial statements, statement of cash flows for the proprietary funds, footnotes, and RSI. So that's true. True, okay. And then the three categories of net position are net investment capital assets, restricted and unrestricted. So that's also a true statement. So now I'm going to ask Linda to take over and walk us through some of the details of the statement, the government-wide statement of activities.
Test, test. Can you hear me? Is that up? I'm going to skip through some of the stuff that seems duplicative of what we've already talked about, just because we're running out of time and we want to make sure we have time for the panel discussion. And definitely time for Bill to excite you with the discussion about pensions. So, Joe showed you a statement there. I'm going to skip that one and that one. Let's talk about capital assets. So you have lots of footnotes you have to accumulate regarding capital assets. The best place to start is with a policy. It's good internal control. It helps you be consistent from year to year. So develop a capitalization policy, make it very detailed. And what you need to address really depends on the kind of government you are. So if you don't have infrastructure, if you don't have streets, things of that nature, you don't have to talk about how you develop the street. If you do, different entities do it differently. You really need to put down on paper your plans for evaluating your infrastructure, what costs are included, and that kind of thing. For example, you can include labor costs. And if you are, what does that include? Does it include benefits? So get as detailed as you can, get it documented so that your auditors can look at it and so that you can do it every year consistently. You got to disclose your depreciation method. FYI, everybody uses straight line. There's no reason to use anything else. Straight line is the easiest. Also, donated capital assets tend to be problematic because there's no cash transaction, right? So maybe a different government grants something to you, donates it to you. People in the accounting department don't even necessarily know that that occurred. Might go to a program manager or something. So you need a way in your organization to track these, first communicate them, track them, and decide value. Acquisition value is what you use. So If you had gone out and acquired that on your own, what would you have paid for it? A little bit about depreciation. We've talked about this a little bit. I'm just going to give you some advice on depreciation. It's not as simple as it sounds. The calculation is simple. Most people do it in Excel. If you don't have software to do it, just use Excel. The hard part is coming up with your inventory of all your capital assets and assigning it to a function. So for example, all your police vehicles, that's easy peasy, right? It goes in your public safety function. But what about all your servers and your laptops and your computers? It's not always really clear which departments they belong to. Assigning that to a function can get more difficult. The reason it's important is you're going to have your function, let's say public safety, then you're going to have the 3 departments. Police, fire, 911 center. They're going to have a list of each of their assets. They're going to have the depreciation expense for the year. You're going to have to subtotal it for all public safety, and that gets reported as an expense in the public safety function. If you don't know where those assets belong, you don't know how to subtotal it. So this is just a snapshot of what the functions and programs for pretty typical government look like. You know, general government, this is your administrative type functions. Things pretty much that don't belong somewhere else go into general government. Public safety is pretty common. Public works is pretty common. You might have welfare and social services, parks and recreation. There could be others, you know, maybe you have garbage collection, you know, whatever it is. Develop your functions. Interest on long-term debt. So this is interest on your general obligation bonds, interest on your capital leases, things like that. That all gets aggregated in one row. You do not have to assign that to the functions. That's a little bit easier. Program revenues is another area that's really difficult. So if you imagine your general fund, for example, and all the various types of charges for services that go in there, you really need to come up with that list and say, okay, what generates this fee or this charge? Is it a program revenue or is it a general revenue? So things like, you know, ambulance fees. So if you have an ambulance service and you charge the residents for the ride to the hospital, that ambulance charge would be a program revenue for public safety, which is probably where your ambulatory services are charged. But then some things are harder, like if you have a department that just sells, you know, maps of the village or maps of the county, that might just be general government. So you have to go through all those revenue streams and assign them to a function if they're a program revenue. So program revenues are basically charges for services, which could be really direct, such as, you know, the map sale. Or it could be a little bit more indirect, like research and permits. So if somebody comes to get a business license or alcohol license, those would be considered a charge for a service because they get something in exchange. They get the right to sell alcohol or to operate their business. Fines would go into this category. And then we have our grants. We have operating grants and contributions. There's 2 types. There's grants that come with strings attached, and there's grants that are, here's the money, use it however you want. I'd say the second category is a lot more rare. Usually that strings attached, right? The grantor is giving it to you for a specific purpose. What is that specific purpose? Where are those expenditures charged? That's the function. That's where the program revenue has to line up. So back to public safety, if you have a police department and they get some kind of a grant to buy bulletproof vests, the grant money for the purchase of those vests are program revenue for the public safety function. Some of these are really easy to figure out. Some are more difficult, especially if you're not familiar with the grant. You're having to dig out the grant agreement and figure this all out. And if you have a lot of grants, yikes, right? This can be a big area.
I have a comment on that. Everything that's on the tax bill where it says it's excluded might not be excluded. For instance, if your stormwater would be on there, that would really be a program revenue. If you collect it on, you could collect it on your tax bill, but it'd still be a revenue stream. That wouldn't be for something excluded, right? It would be a program revenue for stormwater.
But GASB says all taxes are general revenues. So if it's truly a tax and not a charge for a service,
But there's, on the tax bill, sometimes there's charges, that's what I was going to say. Even though you may consider, oh, that's the property tax coming in, there may be fees and charges associated with that that have to be split out.
So like a penalty for late payment, is that what you mean?
No, like actually a stormwater fee or a fee for utility that's on your tax bill. Or like if you collect on your tax bill for something you have to give away, that's not really taxes, like, trying to think of something like weed and sewer expense, which we had to go up most one's grass.
Right, so her question is, it's not always clear what is a tax versus what is something else, and sometimes it comes on
Special
one
assessment.
Lori's gonna
special
weigh in on it.
assessment.
Lori's
Because
gonna weigh
those
in.
assessments you're collecting for someone else, you're collecting it for the stormwater district, you're collecting it for the sewer utility, those aren't county funds.
Right, but I was saying like fee, like if it was stormwater, wouldn't that be considered part of the government if all three of your commissioners sit on that board?
Now you're getting into component units, which is a different decision.
Right, so wouldn't that be part of this?
So if the county is collecting it for another government, it goes in an agency fund and it's not a revenue to the county. So you're holding it temporarily, passing it off later. So revenue
But I'm
doesn't
saying
occur.
if that entity is part of your county, like for us, stormwater utility,
Is it Department of the General Fund or
it's the
something?
department of the county, all three of our commissioners run that, and that would be one of our components, that's what she was saying.
All right, so if it's a component unit, the component unit would be recording the revenue
But they would
Maybe
also
it's
have
financials.
program revenue under their little part of this.
under their part of this.
Yeah, so that would be,
They
so
will
I'm
have to
saying it's not
determine.
everything on the tax bill would be excluded because of taxes. Some would be included, like these fees.
Right, you really have to look to the substance of the transaction, not the terminology used. So if we're calling something a tax that really isn't a tax, you have to determine what it really is and properly classify it. And vice versa, you could call something a fee that really is a tax. It goes both ways. You have to really look at the substance of it. Good point, good question or comment. There's three basic categories down here: charges for services, and then the operating and capital grants. Those are the three categories of program revenues. So if you remember, Joe put up on there the income statement. It starts with expenses, and then from there we net out program revenues to get the net cost of operating a program, and then it shows all the taxes and general revenues that are used to subsidize that activity. So we're talking program revenues, we're talking three things: a charge for service, an operating grant, and a capital grant. And again, those operating and capital grants, well, the capital grants are always a program. But an operating grant can be either or, so you can use the money for whatever you want. It's a general revenue, but it has strings attached, and you have to use it for a specific purpose. It's a program that will go up there with the program revenues. If you have a pass-through grant, whether it's capital or other, you're just collecting it for another level of government and passing it on, but it's not going to go up in your program revenues. And we just kind of talked about a similar situation. Charges for services, again, figure out how that revenue was generated and assign it to that program. So governmental activities versus business type. Fundamental difference between a business type activity and governmental is governmental really assumes there's going to be major taxpayer or subsidy or support. The major source of revenue typically is not a charge for a service. There might be a charge for a service, but the major funding for the activity is going to come through property tax and income tax, something like that. The opposite is true of a business type activity. The majority of funding does come through some kind of exchange transaction, some kind of fee for a service or charge for goods provided. So that's a fundamental difference between the two of them. They both, though, report program revenues, and then those general revenues fall below. But a business type activity will have far fewer general revenues. They have a lot of interest income usually, that's pretty typical, but they don't typically have property taxes or income or sales tax going into those types of funds. So this is kind of what our general revenue section. So it's not in here, but up above we would have our expenses and our program revenues. And then we get to the net of those, which was here. And from there we show of that net expense or net revenue, what else we have going on. So in terms of our governmental activities, the remaining cost of those functions, you know, your general government, your public safety, public works, etc., is about $24 billion. And here's how we paid for it, or almost paid for it. A little bit short, but we have property taxes, state shared revenues, you know, grants and contributions that are free of strings, investment earnings, and then in this case there was a transfer from the business type activities to the governmental activities. Usually the transfers go the other way, quite honestly, so this is a little surprising, but transfers go there, and as Joe said before, they have to net to zero. If this doesn't net to zero, you've got some work to do to reconcile things and figure out what went wrong. Because if one entity has a receivable, the other has a payable, they should be equal. One has a revenue, the other has an expense, they should be equal, right? So we're just moving money between columns. So this lists all the revenues that should be general revenues and that are program revenues, taxes we talked about, and again look at the substance of the item, not the title or the label assigned to it. Grants and contributions that are not assignable, and investment earnings. There are a few little tweaks for investment earnings, but I don't want to get too much into the weeds here. Component units, we already talked about that. I'm going to skip over that. So the governmental funds balance sheet, again, we're always going to focus on those major funds first, and then our non-major funds are aggregated into a single column, and then we have a total of all of those off to the side. We're going to exclude those longer-term items to the extent they aren't due and payable right now. Let me give you an example of what would be recorded in a fund and what wouldn't. And let's talk about claims and judgments. Let's say you're self-insured and you have a health insurance program for your employees. An employee has gone to the doctor's office December 1st and you're December 31st year end, and he has a doctor's bill and he says, I need reimbursement. I know it doesn't work that way, but pretend it does. Well, that's part of a claim and a judgment, but it's due and payable because he had the service and he's presented the bill to you for payment. So that would get recorded in the fund, in the governmental fund. But in addition to that, you've got all the claims and judgments where the bills haven't arrived yet. Or maybe somebody has a serious illness like cancer, and you know that they have a disease by the end of the fiscal year, but you don't know what it's going to cost through the life cycle until it's done, right? You're going to have to estimate that and accrue that. That accrual will go in the government-wide statements because those amounts aren't due and payable yet. Nothing's been presented to you for payment. So we have to kind of separate those two. The vast majority of these liabilities go in the government-wide financial statements, but now and again, a small part will go in the fund. We talked about the fund balance categories a little bit, non-spendable, restricted, committed, assigned, and unassigned. You can put them in total in your statement, and then you have to get into the details of it in the footnotes. So that footnote is pretty extensive. This is basically our income statement, statement of revenues, expenditures, and changes in fund balance for governmental funds. We talk about the format. This is a more traditional format where we have our revenues first and our expenditures second. Our revenues are by source, our expenditures are by character and function. Those are the three that we start with. And current is kind of our catch-all for the things that aren't in the other two categories. I think we've talked about all of this. So just a little bit for the proprietary funds. A lot of questions come up with things, and are they operating or are they non-operating? The guidance from the GASB isn't great in this area. So you're going to have some judgment in this as well. Look to the cash flow statements, and where it's included there is kind of a guideline for where it should be on your income statement. Taxes and grants typically, I would say almost always, are non-operating. We have our who's prepared a cash flow statement in the past 10 years? This is going to be your worst nightmare. Just warning you, these things are very, very difficult to prepare. And you do it, once a year, right? So there's a learning curve every time you do it. I'm just warning you, trying to be honest, these are rough. Don't, net items in your cash flow statement, make sure you're reporting things gross. So if you have something coming in and then going back out, you gotta report the in and the out, not net. Excuse me. So Bill's going to talk to you about pension funds. I think we've talked a little bit about agency funds. Private purpose trust and investment trusts are pretty unusual, so we won't get into those. Statement of changes in fiduciary net position, that's for your pension and your OPEB funds. We report additions and deductions instead of revenues and expenses, but essentially the two categories are similar to revenues and expenses. And then these are just a list of all of the notes to the financial statements, which are extensive. These are the categories. So what I would do if I were you, go to the GFOA's website, Government Finance Officers Association. I think it's gfoa.org. They have a section, I think they call it awards, something like that, and they have checklists for all kinds of governments. And it's free, printed out. It lists all of the footnotes you have. It lists all the statements you need. It has details of what needs to be included in those statements. It's a great checklist. Take a look at that now, and you'll get a sense of where you feel comfortable with where you're at and the knowledge you have and where you're going to need help. So I would really recommend doing that right away, especially since it's free. It just takes a few minutes to print that out. One of your footnotes is you have to have a summary of significant accounting policies. And we've talked about accounting policies for capital assets, and there's some other items as well for that. The footnotes for cash and investments are extensive, complicated, tricky. It's a very difficult area. You're going to spend a lot of time on this, so get it started as soon as possible. It's also very technical, but you're going to have footnote disclosures that talk about your credit risk, whether it's custodial, meaning who is holding your assets and how safe are they, but also credit risk in terms of your investments. Who are you investing in and how safe are they from a rating standpoint? Because you can lose money just by the value in stock or some type of investment going down due to a credit rating or any reason really. You're going to define what your cash equivalents includes. Normally it's investments that mature within 90 days or less. And then you're going to have to disclose credit ratings, debt securities. I mean, even understanding what a debt security is gets complicated, right? If you don't deal with investments all the time, you don't necessarily know what a debt security is. But you don't want to over-disclose things that you don't need to. So you need to get an understanding of what does the GASB mean by a debt security. Some people call them fixed income securities. And make sure you get the right disclosures. And then we have, this is relatively new, GASB Statement 72 has a lot of disclosures for those hierarchies. Again, how accurate is our valuation of those? How do we determine the fair value? It's level 1, it's pretty accurate because there's something that's publicly traded and we can get an exact quoted price. Down to level 3, which is, a lot of significant judgment involved and, maybe not as accurate. You're going to disclose your property tax calendar. First, you need to understand it. You're going to have to understand it to understand how to recognize the revenue. And, governments are different from one to the next, so it's very personal. Capital assets, also expensive footnotes on capital assets. These are a little easier to put together if you have the complete inventory. You assign everything to a function. From there, it's not that difficult. It's gathering all that information, which is very time consuming. Debt, we're going to have tables of debt and balance at the beginning of the year. What did we issue new this year? What did we retire? And what's the balance at the end of the year? And then you're going to describe all your debt issuances and some of the key features of them. For example, what is the interest rate? What are the installments? When is it? What's the final maturity of the debt? And the aggregate, how much debt service do we have in the next 5 years? And then in the aggregate for 5-year periods after that. So you're gonna have a lot of Excel behind the scenes, tables aggregating this and summarizing it. Leases is a big standard that's coming up. So that's gonna be a whole new layer piled on coming up pretty soon. We're not gonna talk about that today, we don't have time. But when leases comes, this concept of operating leases is pretty much gonna go away. So your leases, you're gonna have to inventory those and put them on your balance sheet, similar to debt. So that's fun for a future seminar. Debt refundings, when you issue new bonds for early payoff existing bonds. Typically relates to the gain or loss, and that gain or loss is deferred. It's amortized over shorter in the period, the older the new debt. Anybody have derivatives? Interest rate swaps are common with government. I shouldn't say common, but of the derivatives, those are pretty common. Okay, I'm not going to bore you with this then, if you don't have them. Tax abatement. I think the tax abatement standard got a lot of interest by a lot of governmental entities because they don't want to disclose the deals that they're making to give people tax breaks. But those deals now get disclosed in the notes to your financial statements. So it's twofold. It's what tax abatements have you provided, and usually they're economic development type tax abatements. So, if you have some, Home Depot is coming into the city and you're giving them a rebate of their sales tax for the next 10 years, you have to disclose that deal in the notes to your financial statements. And of course, the taxpayers get mad, right? About that kind of stuff. But it's also tax abatements that other governments do that impact you. So if a county is abating the property tax for a business, and that means you're going to get less property tax from that business, you have to disclose that as well. Hopefully the counties and other governments can kind of work together on this because it takes everybody working together to really summarize and accumulate this data. It's a difficult area. I'm going to turn it over to Bill for pensions.
Thank you, Linda. Can everybody hear me okay? All right. So like all of you, I've been sitting over there most of the day listening to all this. One difference is I've been dealing with it for the last 11 years, and I'm overwhelmed after listening to all this today. So I definitely understand where you guys are coming from, getting this all thrown at you at once. There is a way out. I don't know if the SBOA has approved this, but individually, if you run across the street and buy a lotto ticket, Mega Millions is 900 million. So that's one way out for the winner. And from what I hear, Indiana is a lucky place. I think you guys have more Powerball winners than anybody, so keep that in mind. All right, so I've spent a great deal of my career working on pensions. One of those pensions is the Indiana Public Retirement System, which from what I gather, being counties, cities, towns, and school districts, all of you are familiar with and a part of. Depending on what type of entity you are, you may participate in one or many. I've asked my colleague to pull up the INPERS website, and within the INPERS website, under publications, you can find the GASB 68 schedules. These schedules, for the last several years, are very important to all entities that are needing to report on pensions. Specifically, Joe brought up the financial statements of Allen County. The numbers in there relating to their participation in the Public Employee Retirement Fund, or PERF, would be found in this report. They use submission unit. Submission unit is a number associated with all of your entities. Some of you entities may have more than one submission unit. Keep that in mind. They mentioned that you should be familiar with that, but if you're not, they did give me the name of Adam Repper, and his contact information is on their website. You can call him for further information. All right, we'll go back to the slides. So, pensions and OPEBs. These are a big hot topic item because there have been new standards in the last several years impacting these items. We mentioned GASB 67, GASB 68. 68 is the pension standard. This changed everything for INPERS about 4 or 5 years ago. Coincidentally, that is when we were brought in to help them with the implementation. You may also be familiar with my teams who have visited you. Joe mentioned that a little earlier today as well. So because they administer the cost-sharing plans that all of your employees are a part of, we need to test the data that is being provided to them that is then sent to the actuary to value the liabilities and the related deferred inflows, outflows, and pension expense on an annual basis. So every year we pick a number of you and we come out and we perform testing. You may have seen us. I want to thank everyone in this room, whether you've been a part of it yet or are going to be a part of it in the future. The cooperation and assistance that has been provided, we appreciate it. We wouldn't be able to get it done without you. In addition to us, I know their internal audit department also comes out and performs those procedures as well. Thank you for helping them. It's a key part of their control system. Moving on, so as far as pension and OPEB, what is pension and what is OPEB? Obviously, I talk a lot about pension. OPEB is the other post-employment benefits. So other benefits provided to retirees that is not specific to pensions, those also need to be accounted for and valued. Unlike pensions, a lot of the times there's not a trust set up and set aside assets to fund those benefits. So a lot of those types of benefits are going to be more on your end and at the local level. So if health insurance is provided or accessible for retirees of a county, a school district, a town, then you probably have some sort of OPEB benefit. Evaluation would need to be done by an actuary hired by you locally to measure what that benefit would be and discount it back to report a liability. At the end of the day, within the financial statements, and Allen County is a great example, there's a lot of information that needs to be disclosed for your participation in these types of plans. Today I will go through some of it. I cannot do all of it. As my colleagues can attest, I can talk about pensions probably for a whole day. It would be very boring and a lot of information, but I could do it if anyone is interested. All right, 68, I mentioned, was very important to INPERS. It's very important to you. The requirements of 68 mean that you guys need to record on your government-wide financial statements what's called the net pension liability. The net pension liability is what the actuary measures, the total liability, minus whatever INPERS has in assets, equals the net pension liability. Also, the actuary measures pension expense on an annual basis. Finally, they have what they call deferred inflows and outflows. There are specific categories of deferred inflows and outflows. Most of them are measured directly by the actuary and included in the valuation. I did show, we pulled up that website a little while ago. That website also included all of the valuations. A little bit above the GAAP 68 schedules, there was a link to all the various valuations performed by their actuary over the last several years. That information includes all of the information you guys need to report the numbers. It does not provide everything as far as narrative. It does give you the schedules. But like I said, it's very extensive. There is a lot. The GASB provides examples. Allen County, assuming they're following the templates, would be a good place to start to get all the information you need for your statements. All right. I've talked a lot about INPERS. INPERS administers 4 cost-sharing plans. PERF, the Public Employee Retirement Fund. All cities, towns, counties would be a member of that. Actually, most school districts would probably be a member of that too for the administrative people. The Teachers Retirement Fund, there's 2 different ones. There's the pre-96 and post-96. All school districts, I would anticipate, would be members of those funds. Finally, there's the 1977 fund for police and firefighters. So that would also, I would assume, at the very least, cities and towns would all be members. Not sure about counties. You would know more about that. One thing I do know is that a lot of counties do administer their own sheriff's plan. For the sheriff's plan, you guys are responsible as the single employer and the administrator for obtaining the actuarial evaluation, approving the methods and assumptions, and essentially all of the information needed. INPERS doesn't have anything for you guys other than some maybe assistance with the format. All right. I want to go through some of the required disclosures. One of the required disclosures is you need to name every plan for which benefits are provided. You need to identify whether they're administered locally, like the county sheriff's fund, or through INPERS. You need to identify each plan. You need to provide a brief description of benefit provisions under the plan terms, the number of employees that are covered by the plan, and if standalone financial statements do exist, you do need to refer to how to obtain those. So for INPERS, you would refer to their website and provide a link to where you can get those statements. In addition to that, you need to disclose the actuarial information. So on an annual basis, an actuary will measure the liability, and several assumptions and methods, or a method and several assumptions will be used to support that measurement. The discount rate is one of the major assumptions. It is established based on the long-term rate of return on plan assets. Underneath the long-term rate of return, if the actuary will do a measurement. If the plan is well-funded, they will look out at least 100 years and determine if assets ever run out. If they do not, you can measure and discount the liability back using that long-term rate of return. If in that analysis the assets do run out, then you need to stop at the point that they run out and discount it back using a long-term municipal bond rate, which is generally much lower. What that means is the lower the discount rate, the higher the liability. And the footnotes, one of the disclosures is a sensitivity analysis showing, depending on what the rate actually used was, they'll show a plus or minus 1% to show people how much that could impact the measurement of that liability. You need to disclose a table which shows the changes in the net pension liability and all the various ins and outs. You need to disclose the deferred inflows, outflows due to, as I said earlier, there are several buckets. Changes in assumptions. Every year evaluation is done. If an assumption change is made, it will have an impact on that valuation. That impact needs to be now recognized as a deferred in or out, depending which direction it goes, and amortized over a period of time. Same with the differences between expected and actual plan experience. Every year the actuary is using assumptions to guesstimate what's going to happen. And every year they're wrong because they're guessing. It's an estimate. That difference between what actually happened and what they assumed would happen is deferred and amortized over a period of time. Finally, differences between expected and actual investment performance. Again, we use that long-term rate of return. We assume that we're going to make X% annually on our plan's assets. However, you're either going to do better than that or worse than that. I have never seen a plan do exactly what they said they were going to do. The markets don't work that way. So at the end of the day, that difference needs to be amortized over, that one's actually a closed 5-year period. So slightly different than the other two. But I guess I'm going to stop now and just ask, does anyone have any questions? I know I'm talking fast. I know I just threw a lot of information at you specific to pensions. Has anyone dealt with INPERS, dealt with us, have any questions related to why we're there, anything? All right, I'll keep that. Okay, so I went over all the note disclosures. The note disclosures are the audited fees that are found within the notes to the financial statements. Also included for the basic financial statements is required supplementary information, or RSI. Several times during the presentation we mentioned RSI. These are schedules found just behind the footnotes that will include 10-year historical information on the pension liability, any OPEB liabilities, budget to actual schedules for your general fund and major special revenue funds. I won't talk about that. Within those schedules, these items need to be included. For INPERS plans, all of these items are nicely laid out and provided within the actuarial evaluation on an annual basis. So you can find exactly what you need from there. In addition, because it's a cost-sharing plan, you need to also pick up what percentage of the liability you're picking up compared to the whole. All right. We'll skip through some of those details because I am pressed for time. I do want to get into a little bit of what GAAP Statement 75 is. I talk a lot about pensions, and I define what other post-employment benefits could be. Similar to the pension side, liabilities now need to be reported for the measurement of the net or total OPEB liability. The OPEB liability is also actuarially measured, and a lot of the disclosures are going to be the same as the pension disclosure. In addition to the liability, just like the pensions, there will be an annual expense amount and also a deferred inflow and outflow associated with it based on the various reasons. Measurement of the total OPEB liability and the amounts, a lot of this is going to be the responsibility of the local entity. As far as I am aware, there is no health insurance plan that the state administers, and there's no assets set aside for all of you guys associated with it. Each individual local government administers their own, and each individual local government needs to work with an actuary to estimate what that amount would be. If I'm incorrect, please someone correct me, but that's how I believe it would be here in Indiana. Because you are responsible for that valuation, you're responsible for the census data provided to the actuary to measure it. And as auditors, anyone who's auditing your entity would be responsible for testing that census information. All right. I will go quickly through this because I've touched on a lot of it with the pensions. A lot of the disclosures for GASB 75 and the pension, or the OPEB stuff, is the same as the pension stuff. You need to have general information about the plan description, the benefits provided, the number of employees covered, etc. You need to include actuarial assumptions for the measurements. You need to include the changes in the net OPEB liability table, similar to the pension. It's a roll forward from the beginning to the end and all the various reasons and items that play into why it changes, which will all be included in the actuarial evaluation. And then you need to have that sensitivity analysis I briefly touched on talking about the discount rate. You'll need it for the discount rate, but for OPEB plans, you'll need it for another reason. There's two analyses here. The second requirement is related to the healthcare trend rate, which is something used by the actuary to measure the liability. They need to also show a plus or minus 1% difference in that trend rate and how that would impact the valuation. Similarly, also, the RSI requirements, the 10-year historical schedules going forward, the changes in the liability, the schedule showing the liability as a percentage of payroll, and then you need notes to those schedules.
Bill, skip ahead to this polling question. There we go.
All right. Polling question 13. Capital assets must be segregated on the face of the financial statements between depreciable and non-depreciable assets. Is that true or false? True. Good job. True or false? The disclosures associated with pensions and OPEBs are expensive. That's why. All right.
All right, we're coming to the home stretch, guys. I just want to spend a few more minutes, and I want to talk a little bit about this conversion from modified accrual to full accrual. Sorry. Is that better? Hello? Okay. Talk a little bit about the adjustments, converting from modified accrual to full accrual. Essentially, what we have to do is account for everything on the reconciliation statement, all of the differences between what's recorded in the governmental funds and what's recorded on the full accrual financial statements. This is a laundry list of the type of items we typically find in that schedule. And there's a lot of different ways to do this. We can do this through an Excel schedule or some off-book adjustments. Some organizations may even set up a separate fund to do this reconciliation. That way it gets into their system and they have the ability to track these year after year and keep track of the type of adjustments they are. So I'm just going to go through this quickly. The adjustments worksheet, again, we can use a traditional worksheet, but at the end of the day, we want to be able to reconcile, again, the fund financial statements to the entity-wide. So what are the type of things we're talking about? On the capital assets, we need to capitalize land and equipment that are reported as capital outlay on the fund financial statements. Long-term debt. We're not reporting long-term debt within our fund financial statements, so that has to be added to the governmental activities. Debt service. Again, debt service is recorded as an expenditure on the fund financial statements, and it's a reduction of bonds payable on the government-wide. Depreciation. We've talked extensively about depreciation, and this is what Linda was referring to when she said depreciation has to be recorded by function. So we have the various functions: general government, public safety, highways and streets, sanitation, culture and recreation, and then we report the accumulated depreciation: buildings, improvements, equipment, and infrastructure. And if you could imagine the details behind an adjustment like this, it's pretty extensive. So the whole fixed asset reporting and tracking of assets and depreciation is really pretty complex. Unavailable property tax revenue. We said that the unavailable piece becomes available at the entity-wide level. So that's typically an adjustment. Certain payables that are not reported as expenditures in the governmental activities have to be reported at the entity-wide. So we have, some of the unusual items we talked about before. Accrued interest, compensated absences are reported differently on the fund statement as opposed to the entity-wide. Accrued interest, again, we don't have accrued interest payable on the fund statements. We typically match our debt service payments with when they're paid, but on the entity-wide, we have accrued interest to account for. Amortization. If there's any amortization of bond premiums or discounts, that will also need to be part of our reconciliation. Internal service funds. We don't report internal service funds at the entity-wide level. So those funds have to be evaluated, and they have to be combined with either the business type or the governmental activities, or potentially allocated depending on which ones they're serving. So to the extent we have internal service funds, that could create quite a bit of additional work as well. Interactivity balances, just making sure that they're reported, and transfers, and make sure that they net to zero. So we are right at 2 o'clock. It's break time. Let's take a 15-minute break, and we're going to resume at 2:15 with the panel discussion. So if you all have questions, get those questions ready for the panel. Get your evaluation forms out. Get those filled out if you can during the break, so that when you go, we can just drop those off. And if there's any questions, or anyone has anything they'd like to chat about, just let us know. So let's get back together at 2:15.